Welcome to Real Estate Conversations from Compass. I'm Mike Simonson. I'm the chief economist for Compass, the largest real estate brokerage in the country by sales volume. My mission is to help everyone understand what's actually happening right now in the real estate market so they can make the best decisions when buying or selling a home. With Compass Intelligence, we publish the latest data every week. You can see that data and my video analysis on the Compass YouTube channel, and you can get on our Compass Intelligence mailing list. We put the data, video, and charts in your inbox every Monday. With the Real Estate Conversations podcast, I seek expertise and insights from the best leaders and thinkers in our industry. These conversations help me understand and hopefully help you understand the trends and dynamics driving the market today. So stick around for more real estate conversations. Today's conversation is with Matt Graham. Matt is the COO of Mortgage News Daily and MBS Live. A former loan originator, Matt is now recognized as one of the industry's foremost innovators in mortgage market data services. In 2006, Matt recognized the challenges in communicating the complex, dynamic world of mortgage rates into simple terms that everyone can understand. At Mortgage News Daily and MBS Live, he built the data systems for solving those challenges. Matt is routinely featured in the media as a mortgage rate expert and is responsible for helping several major media outlets modernize their mortgage rate reporting. So if you see news during the day with mortgage rate headlines, chances are you're seeing data from Matt and Mortgage News Daily. I asked Matt to come on the show because mortgage rates are on the top of everyone's minds right now. The Fed is cutting, but will home buying get more affordable? What factors are driving rates up or down in 2026? If you are in this real estate market and you are looking to understand mortgage rates, where they're headed and why, this conversation is for you. Stick around for Real Estate Conversations with Matt Graham and me, Mike Simonson. Matt Graham, welcome to the show.
Hey, thanks for having me, Mike. Good to be here.
Let's start today with your two companies, the MBS Live and Mortgage News Daily. We're talking about mortgages today, and you have built both the data side and the news-facing side that is really has become the go-to source for, like, when the headline says mortgage rates did this today, they're really quoting your data, and very often quoting your data and the at Mortgage News Daily reporting on current mortgage rates. Tell us about that operation and what we're doing there, and a little bit about that data.
Yeah, no problem. I mean, and it's an honor to have risen, I guess, to be that source, but sometimes a bit of a surprise given the simplicity of what we're ultimately doing with rates. But to go back to the beginning, Mortgage News Daily actually existed before I got there, and I'd corresponded with the owner / editor at the time leading into the financial crisis because some of the coverage, said certain things. And I'm like, well, I could write better than this, or this is not really accurate. Here's why the story is different. And that guy said, well, write a story and I'll publish it. And so I did. And one thing led to another. And I quickly became the analyst, if you will, for mortgages and MBS. And the rest is sort of history. But Mortgage News Daily, even before I got there, has always had a commitment to being relentlessly objective. We don't really do the clickbait thing. We're just trying to get to the heart of the matter. And sometimes that's not always as interesting because sometimes things are boring and sometimes things are flat. But the thing about it is people can always trust it to be on the mark when it comes to what's actually happening. And that served us quite well, especially post-COVID, when there was a lot of conflicting information on what rates were doing and also a lot of fast movement in rates. that benefited us because we report rates every day, sometimes a couple times a day. We can talk more about the methodology behind that to some extent, the non-proprietary parts, but that is really,
That's
what's taken our rate and our rate index to the top is just an objective capture of what's really going on in the market.
Yeah, and I definitely would like to talk about the methodology a little bit and how we can use that to understand really what's happening in the market and ultimately, home buyers and sellers and what they should be thinking about. Let's first talk about the broader mortgage landscape right now. Mortgage rates have been high for 3 years, and everybody wants to know when are they coming down, and everybody wants to know the magic number. What number will finally get buyers and sellers off the fence? And like all of these things about rates, which is so very sensitive. And meanwhile, I think which is underreported, which is rates could go up from here because everybody is hoping rates go down. So let's talk about the broader mortgage landscape. We're recording this in sort of mid-September right now. It'll be a couple of weeks before it comes out. Tell me about the landscape and what you're focused on and what home buyers and sellers should be thinking about.
Yeah, it's definitely an interesting time. Rates definitely went up faster than a lot of people expected, myself included, in 2022. In hindsight, those reasons are pretty obvious. Inflation rose faster and stayed higher longer than a lot of people expected. And that's been one of the key drivers. But you also have the economy as a driver and a strong labor market for those 3 years. And if you had to encapsulate everything that's happened over that time in the quickest way possible, it would just be to say it's been very, very sideways in the bigger picture. Yeah, we had a little bit of a disconcerting spike in late 2023, but other than that, you can go all the way back to late 2022 and see that rates have really just kicked around in this broad sideways range since then. And I think that actually makes a lot of sense relative to the things that rates care about, which are primarily the labor market and inflation, because you've had steady ish economic data. I mean, we haven't had a bona fide recession or a recession scare during that time. And inflation hasn't really gotten the type of traction that one would hope for in order to expect sharply lower rates. So we're really just waiting for inflation to give a super clear signal that it is actually going to return to the Fed's 2% target, as opposed to adopt this new regime where it stays between 2.5 and 3%. And once that happens with inflation, or once the labor market says, oh, hey, we're headed toward a recession, we're still waiting for rates to make a big change. Now, in September, it's starting to look like the labor market might be deteriorating enough for rates to make a more meaningful move lower, and they've already started to do that. But just like we saw at the end of 2024, the market can give those signals and the economy can give those signals only for subsequent months of data to completely change the picture and force a big bounce in rates.
Right. So last year at this time, we had a momentary low, and then suddenly there was a strong jobs report, and whoop, rates kicked right back up again.
Yep. And a lot of people have asked me, hey, look, are we setting up for a repeat of September 2024? Because, as we're talking right now, we're looking forward to next week's Fed announcement, which will be the first rate cut in a while, just like last September was the first rate cut in a while. And I think a lot of people painfully remember that rates began moving higher almost immediately after that Fed meeting, and led some people to conclude that the market sort of bought the rumor and sold the news, if you will, and priced in these lower rates courtesy of the Fed rate cut. And then after the rate cut was a reality, then it was free to quote unquote sell the news. It's actually not the actual course of events. It had everything to do with a jobs report that came out a week and a half later. If that jobs report hadn't been so strong at the very beginning of October 2024, we would not have had the bounce that we had late last year. So if this next jobs report in October sings a similar tune to the last two we've seen, rates don't necessarily need to bounce higher. In fact, if the jobs report's weak, rates could even go lower.
Yeah. And yeah, we've had a series of weak jobs reports, new claims, initial claims on unemployment was spiked this week. So the jobs data looks significantly softer than it did a year ago.
Yeah.
And but meanwhile, though, the inflation is still not there yet. And so if we're thinking about inflation and jobs, like if inflation stays up and jobs get worse, which do rates care about more?
It's everything's relative. So if jobs get bad enough, the market isn't really going to care as much about inflation. And the Fed speaks to this when they talk about their dual mandate and their mandate being intention. And mandate's just like a fancy word for their job description, their goals. And the dual mandate refers to the Fed's goals to keep employment pretty good and to keep prices from going too high. And they've said that even if their inflation mandate isn't showing what they want it to show, if the jobs market weakens enough, they'll give precedence to that and make rates more accommodative, i.e., cut them.
Yeah. But of course the Fed and the bond market, especially with at the long end with mortgages, are not the same.
Correct. Huge misconception out there, and something that people can't hear too many times when it comes to your average mortgage market participant, your average realtor, and especially your average home buyer. And the media doesn't do them a lot of favors, not because they're trying to mislead them, but because Fed announcements are big business, and it's always good policy to cover what the Fed's doing with rates. And the Fed funds rate does matter to a large portion of the financial market, but the Fed funds rate doesn't dictate mortgage rates. The Fed funds rate only moves 8 times a year because the Fed only has 8 scheduled meetings a year. Yes, there have been emergency cuts, and some people talk about emergency cuts or emergency hikes, but we're not in an environment where that's at all likely right now. So you're really looking at 8 times a year, whereas the bonds that underlie mortgage rates probably moved 8 times in the sentence I just said, and thousands of times during the day. So they will have long since adjusted to reflect the reality of the same data that the Fed is going to be considering when it meets to cut rates 8 times a year.
Yeah, that's an excellent way to put it. And we will make sure that one of the highlights of the reason we do this episode and we're doing the podcast is, as you know, Compass has 37,000 agents, and we work with a ton of home buyers and sellers. And so this is about how can we get the best information beyond just the data into like really helping people understand what's happening in the market now. And so in the mortgage space and what's coming up in the mortgage space is like this is I appreciate your insights here. So okay, so we've got as we're recording, we have a Fed meeting next week, FOMC meeting next week. They're going to cut, basically certain that they'll cut 25 basis
Yeah.
points. Um, and uh, and mortgage markets have been moving down in early September. And they were about 6.3%, give or take, the last time I checked. I didn't check Mortgage News Daily today, but I'm
No,
sure
you're
they're
close enough. Yeah, it's 6.29. Might as well.
2.9 today. Yeah. And so as we look at the fourth quarter, we see jobs seem like they're trending worse. Inflation is mixed. Are there other factors that might drive rates that are bubbling around that we should pay attention to?
Well, everything else is a distant second after the labor market and inflation. One thing that has complicated the post COVID era is Treasury issuance and the general nature of the fiscal situation and revenues, because the government, takes in so much money and spends so much money, whatever those numbers are. Any shortfall needs to be covered generally by issuing treasuries. And right now, with rates as high as they are, that all new treasury issuance is going out the door at fairly high rates that create a higher interest burden for that government debt. So the US government is having to pay more interest than it has in a long time to service its debt. And if there's revenue shortfall and they have to make more interest payments, they got to get that money from somewhere, and they get it from borrowing even more treasuries. So it's sort of a vicious cycle. of debt service and treasury issuance, and it keeps it elevated. And as long as treasury issuance is elevated, it puts upward pressure on rates, all other things being equal. It's one thing to simply say those words and to know that that's the case, but if people want to understand the underlying dynamics, it's not too complicated, and I'll try to walk through it really quickly. But like everything else, with supply demand 101, the more supply there is of something, the lower the prices will generally be. And when the government is issuing more debt, that means there's a higher supply of treasuries, bonds, notes, bills, and that higher supply pushes prices down. When it comes to bonds, the price of a bond varies inversely to the yield and or rate. So the lower the price goes, the higher the rate goes. And you can think of that like, hey, there are so many of these things out there. If I'm an investor, you're going to have to pay me more interest in order to want to buy them. And that's one way to think about the price going lower and the rate going higher. But in general, yeah, treasury issuance, upward pressure on rates, and it's not something that can sort of quickly be overcome. And it creates a lasting source of upward pressure and an evil cushion under rates that keeps them higher than they were in the past.
Yeah. And we are absolutely in a massive spend and borrow cycle. Like it's growing even more this year. But you still think so that's one that kind of worries me about long-term rates. Like, can we get lower because we're like issuing so much that we're borrowing and spending so much more? But you're saying that is a really a distant second. What I should be paying attention to is the labor market.
Yeah, I think, if you were to tell me that the unemployment rate was to jump from 4.3% to over 5%, or maybe in a recessionary scenario, 6, 7%, I think people would be surprised at how much farther rates could go down, just because the shortest term rates, Fed funds rate, that's sort of setting the anchor that all of the rest of the rate world radiates out from. And it also lowers Fed borrowing costs, or not Fed, government borrowing costs, because a lot of the debt that we issue is short term. Even a 2-year treasury is not super short term, but that has a lot more correlation with the Fed funds rate than, say, a 10-year treasury yield. And so that helps this ancillary factor that we're talking about with treasury issuance in and of itself.
Yeah. I've seen you talk about this. The bad news for the economy is good news for rates dynamic.
For sure. Yeah, that's a quintessential bond market wisdom.
Yeah. And do you think have you considered about we've had basically full employment for many years with a little COVID blip. We've had unemployment's been very low for many years and now it's starting to rise. Over the next year, if we like one of the scenarios that gets lower rates is recessionary environment, unemployment starts to climb. Uh, in a weakening environment, in a weakening economic environment, fewer employment, less certain jobs, um, but a cheaper mortgage rate environment. Do you have a take on buyer demand? Like, which wins?
Yeah.
You know?
Yeah. That that's always a good question. And I think it won't always play out the same way. So during the financial crisis, which was very mortgage centric, the housing and mortgage market was very slow to realize the benefits of a stronger labor market, even though rates were very low. Right now, I think that rates have been one of the bigger impediments to the housing market and refi demand to whatever extent your audience cares about that relative to purchase demand. So, I think that if rates drop, say, another percent, you see a much bigger shift, a shift that's measurable on the purchase side. We're already seeing maybe a little bit of an uptick on the purchase side just from the most recent drop in rates. But by and large, purchases have been more steady, and it's the refis that fluctuate with rates. But when you look at longer term, bigger picture charts, it's pretty clear to see the correlations between rates and purchases. And so it's more a question of the movement in rates being lasting. And even if unemployment rises to 6%, you still have plenty of people with jobs that can qualify for house payments that will definitely show up in the data in a meaningful way. In other words, to get to the heart of your question, low mortgage rates ultimately win out, even if unemployment's rising, as long as unemployment isn't rising due to a mortgage specific financial crisis.
Right. Okay. Yeah, yeah, yeah. That makes a lot of sense. In other words, there's still a lot of people with jobs, even when unemployment is rising. So
Right.
a weakening economy really that drops rates has a likely a better impetus, a better push for housing demand than the negative side of recessionary job loss.
Yeah.
Awesome. Okay, that's particularly insightful. I appreciate that. And that's actually kind of optimistic for our industry over the next year. And so then if we think about over the next year, do you have a forecast yet for 2026? Are you thinking about, do you have a framework for how you like to think about what would happen for rates? And maybe the question to ask first is what was your call for 25? And do you feel like you hit it?
I am notorious for not doing predictions. In fact, I have a knowledge based article on MBS Live that's entitled Predictions Are for Suckers. And one of the main reasons that I continue to pound that drum is that we're dealing with financial markets and money is smart and the money doesn't lie and you follow the money to find the reality and you have trillions of dollars moving around every day that are betting on what's going to happen in the future. I mean, not all of those dollars do that, but many of them do. And I sort of have always felt that it would be either overconfident at best or naive at worst to think that you as an individual can know more than the collective wisdom of all of those dollars moving around. As forecasts, specific forecasts, I don't do them, but I will comment on a range of possibilities for sure.
Great.
And I usually play it pretty safe with that, but there have been times where my range has been off. For instance, I didn't see rates going as high as quickly as they did in 2022. But when it comes to looking ahead to 2026, what I think I've seen from this sort of this time frame that forced me to reevaluate my range of possibilities is that there seems to have been a bit of a natural break on the economy and on home buying demand and all the rest of it at the point that rates got above 7%. And yes, we briefly hit 8% for a day or two and spent some time up in the mid to high sevens, but those were sort of temporary blips. And it seems that we now know enough about how inflation is settling and how the labor market is behaving that the fears that drove those rates that were closer to 8% are sort of in the rearview mirror. And I think that in a scenario, and I think it feels a little bit unlikely at this point, but in a scenario where this sort of burgeoning labor market weakness that we're seeing right now dies down and the labor market resurges and the unemployment rate drops from 4.3 back to maybe 3.9. Again, not saying that's likely, but if that were to happen, I see that coinciding more with mortgage rates around 7%, maybe, 7.25, as opposed to moving up to 8%. And when you see some people talking about 10% mortgage rates, I don't think that's a thing. Yeah, notably, I didn't think 8% was going to be a thing back in 2022, early 2022, but it was. But this time, I'm sure that I'm right. Well, I'm more sure.
Well, it gets to a couple of other points though. So basically, you see things still moving sideways. We get unemployment potentially rising, jobs market softening, which brings downward pressure. So in general, you see uh, like a lower distribution on mortgage rates in 26 than we have in 25.
Well, I mean,
Spend more
just
time.
now, just now, I was talking about the bad scenario, but we can talk about the good scenario. Well, not the good scenario for the economy, but the good scenario for rates. So, in that negative economic scenario where unemployment, let's take something sort of middle of the road. If we're at 4.3 today, let's say we move up to 4.5%. And then you have one big variable that you need to address in determining how low rates could go, and that would be what happens with inflation. And some people are worried that we're just stuck at 2.5 to 3%. But let's say in whatever is happening with the economy also helps inflation get back to 2%, maybe in such a way that the Fed has to cut so aggressively that it's sort of trying to stave off a significant dip below 2%. In that case, then you could be talking about today's 6.25% rates moving down under 5%, or at least to 5%. And that's a whole new ballgame for a lot of people out there, both on the purchase and refi side. And in a more dire economic scenario where there is a serious recession for whatever reason, and we don't see that on the horizon for any specific reason right now. It seems more of like a slow burn. But if something were to come along that created that more legitimate recession, then it's still not crazy to think that mortgage rates could be in the fours.
Okay, that'd be a fascinating, change in the whole perspective about what's
And it
happening.
happens faster than people think, too. These changes can be really precipitous.
Yeah,
So it would be like all of a sudden you get 3 jobs reports in a row that are saying the same really bad thing, and now rates are 1% lower than they are today, like overnight. It can take a month.
yeah, yeah. Well, we will we'll hope that those don't happen between the time we're recording and the time we're talking, or maybe we do hope that they
I
don't.
mean,
They
people that
don't.
need to refi that aren't going to get laid off from their jobs would love it to happen, I'm sure. But yeah,
Yeah,
that's the eternal moral trade-off of hoping for low rates, is you're also sort of hoping for economic pain for other people.
yeah. That's true. We hear that on the purchase price of house side too. People are saying, all we need is a 20% crash in home prices, and then everything will be good again.
Right.
It is a moral challenge. There are a couple other questions that folks have been asking me lately, and I'd be curious about your take on it. One of the dynamics in the mortgage markets is the spread between the 10-year and the 30-year fixed mortgage, and as the underlying as the 10-year yield went up in 22, the spread increased too. So there was even more mortgage rates were even higher. I think the spread is compressing now. And do you have a take on like the dynamics in the back end of the mortgage market, that why that happens and what we're likely to see going forward on the spread?
Yeah, so there's been like this puzzling, well, I guess it's not puzzling, but an unwarranted hyper focus on the spread. And I think because mortgage rates were so high and it was painful, and people were sort of clamoring for any notion that mortgage rates could come down. And people tried to figure out a way, hey, how could they come down even if the broader rate environment is staying sideways? And the spread seemed like a natural thing to focus on because it was so much higher than it had been in the past. But it was higher for logical reasons. It had a fairly important shift from the Federal Reserve, who had been a big player in buying mortgage backed securities. So those are the bonds that dictate mortgage rates. And when the Fed buys a lot of them, as they did during the QE years, it pushes mortgage rates significantly lower. And as early as the Bernanke days, they started talking about getting back to a quote unquote primarily Treasury securities portfolio, meaning that of the bonds that they bought and owned, they would like to just keep the Treasuries and get rid of MBS. Now, at the time, they made it clear that they weren't planning on selling MBS. That would have been even worse for mortgage rates. But the notion of selling MBS has come up several times in the past few years from several Fed members. And while Powell has said it's still not the plan to do that, he hasn't ruled out that it's a possibility. So without that reassurance, there was concern that the Fed could further shun MBS, and that would put upward pressure on mortgage rate spreads. And also, when you have crazy volatility, MBS and mortgage rates always tend to blow out in spread versus treasuries. And anytime that the market needs to really focus on a risk-free safe haven, they're going to buy treasuries before they buy MBS. So that's another reason that spreads blew out. And then once rates are high, you have this scenario where investors are concerned about owning mortgage debt, because if rates drop, now all of a sudden those investors are going to get paid off early, EPO'd, as we call it in the biz. And what that would mean is that they would have paid what was at the time a market price for a certain rate of return in mortgages. But they will not realize that rate of return if everybody that is borrowing in those underlying mortgages goes out and refis at new lower rates. Now they'll get their principal back, and their realized return on that will be a lot lower than they thought it would be, and they'll have to put their money back to work at a lower rate of return. So what they do is they just show a drastically lower preference for the mortgage-backed debt, and that keeps spreads very high. It's not until rates start falling on their own and the MBS coupons that allow investors to focus on lower rate mortgages with more insulation against that refi risk. It's not until that happens that you start to see spreads come in. They've also benefited from the nature of treasury issuance that we talked about earlier. And if there's excess treasury issuance, it's putting upward pressure specifically on treasury yields, and MBS are immune from that. MBS are always going to have some correlation with treasuries, but if treasuries have that specific concern about issuance, they won't that won't spill over to MBS as much as it normally would.
Okay, that's an excellent lesson on the spreads. And in fact, as rates have been easing down, as you point out, the spreads have actually been compressing also in recent weeks.
Well, and also you have to consider what spread you're talking about, because a lot of people focus on the 10-year treasury. And in the past, that's probably been the best one to use. And in some ways it still is. But at times, and maybe even right now, it would be better to use a 5-year treasury. And for some mortgage rates, it's better to use a 2-year treasury, which just seems crazy from an old school mortgage watching standpoint. And when you look at those spreads, they're not doing things that are as dramatic, because those shorter term bonds had outperformed quite a bit over the past year as the yield curve has steepened, which is a byproduct of expectations for a lower Fed funds rate. And it means that there's some nuance to saying spreads have come in. They have, but just not quite as much as people who are following the 10-year think they're coming in.
That's great. That is really like totally understandable. You use maybe the 2 year as the benchmark because these things are going to get refinanced in 2 years, kind of thing. Is that really
Yeah.
why that ends up happening?
Yeah, yeah. And you're not necessarily using 2 years as a benchmark as much as you're sort of sprinkling in a a certain portion of 2-year treasuries into your overall model that is sort of gauging the relative value of MBS, because some people are going to keep their loans more than 2 years, even if they could refi for other reasons. Maybe they don't qualify, maybe they just don't get around to refinancing, whatever the case may be. So while some people will refi sooner, others may not. And the average lifespan of that loan is what matters when you're picking the best treasury duration to benchmark your spread to. And I think you could say 5 years, pretty safe right now.
Yeah. Believe it or not, some people don't pay attention to mortgage rates every day, and they may
What?
not know that there's an opportunity to refinance.
Yeah.
I don't know who those people are. They exist though.
Well, it's not for lack of trying, man. I mean, but
Exactly.
that does raise a good point that I've noticed. It's an interesting thing that I've noticed over the years is that sometimes these refi opportunities are fleeting, and you have these insanely good rates that only show up for a couple hours on a single day. And that's been the case a few times. And it's been a situation where a lot of borrowers will be out of the money if they didn't catch that narrow window, let alone the borrowers that are looking maybe every month.
Yeah.
Fortunately, right now, the rate rally has been stable, but it won't always be the case. And sometimes you'll see just a fleeting opportunity that you got to jump on.
Yeah, I think about that myself where, I'm in the data. I'm not in the mortgage data really deeply, but I'm in the housing data every day. And in 2021, like I missed the best opportunity by 6 months before I finally got around to say I should probably go get this, right?
Yeah.
And I'm in it. There's another question. So that's a great like tutorial on spreads and how those are impacting rates. There's another question that people are asking about. It's been in the news that the administration is like, maybe we should spin out, or maybe they're even talking about we should spin out Fannie and Freddie from private government conservatorship into purely private ownership. And the question is there, people want to know, does that have impact on rates? Does it make rates better or worse or not, no, nothing at all? Or like, is there something, is that a variable in 2026 that could go like, all of a sudden everything's different because those guys buy all the mortgages?
Right. Yeah, it's a great question to think about and a complex question to consider or to answer in a definitive way with a high probability outcome because we don't really know exactly what this exit from conservatorship would look like. There are a range of possibilities, but none of them have anything to do with making Fannie and Freddie what they were in 2007 before the conservatorship. So they're not going to go 100% back into public stock ownership. In fact, it would be a small fraction of that, best I understand. And also, this time around, even the president has said that, in fact, his exact words were, I want to be clear. The US government will keep its implicit guarantees. And what that means is what the market had always assumed about Fannie and Freddie before the financial crisis, which is if, whatever hit the fan, then the government would step in and make sure that they didn't go bankrupt, which they did. And the president is saying to investors, you can buy this stuff and not worry about having to take a haircut because that would absolutely cause massive upward pressure on rates. And that's the reason that some people, upon first discussing this deconservatorshipping of Fannie and Freddie, say rates would go higher because they're drawing this conclusion about the guarantee, the explicit government guarantee, currently explicit due to conservatorship. Therefore, if no conservatorship, no more explicit guarantee. And yeah, there wouldn't be an explicit guarantee, but if it's implicit, it's good enough. If it's not going back to the way it was in 2007, there's not a ton to talk about in terms of what would happen with rates. I think that you could see some aspects of that move push a little bit toward higher rates if there were new G fees that were introduced to cover certain things. But the key thing that would need to happen, and I'm a little bit out of my depth on this, this is really the realm of housing lobbyists and the housing folks that work in DC and stay in the loop on that. But best I understand it, the thing that really would need to happen is that this $240 billion backstop that's currently in place between Treasury and the GSEs would need to remain in place and be made explicit. And if that's the case, then that will effectively replace the explicit guarantee that exists in the current form of conservatorship, and that will preserve the investor demand side of the equation. Other people talk about changes in loan level price adjustments or the G fees, but FHFA would still be in control of those. FHFA doesn't have any real incentive to lower those. It's one thing for Pulte to say he wants to make housing more affordable, but at the end of the day, you're talking about taking money out of the pocket of the U.S. government because that money is still swept to Congress. So that's revenue for the government, and it's not something the government tends to want to give up very easily just to be nice guys. So that's another reason that you shouldn't expect any major change from that.
Got it. Okay, that's a useful overview, and it kind of makes sense to me. There's a devil's in the details, but also even if we start moving it out of the government hands, there's still a vested interest in not screwing things up too dramatically, like not messing the markets up dramatically with a move like that.
Yeah, and out of government hands is one thing, but there'd still be a ton of government involvement. It would just be less than it is now.
Right. That's true. Right. It's still because FHFA still sets the rules on who qualifies and how you pay for them and all of the elements there.
Yeah, yeah. They're not going to become private companies.
Right. Right. Okay. So that's terrific. And an interesting, like those are a lot of questions on people's minds. One of the questions that I get all the time is what's the magic number? What's the number where suddenly consumers are buying homes again? And I have a view of what that number. I have a magic number. I'm curious about what yours is and how you get to that number, if you have one.
What's your magic number?
Have mine. So I see that in the last 3 years, there's been two moments when rates really dipped below 6.5, got closer to six, and it was early 23 and it was September last year. And in both of those cases, we saw an uptick in weekly pending home sales. We saw support in prices, surprising support in prices in both cases. We could measure inventory drops. Like there was notably demand when we got 6.5 didn't move the needle, 6.1 did.
Right.
So that's where my magic number is.
Yeah, and I think you're right on. I think as soon as, and when you see 6.1 on like Mortgage News Daily or elsewhere, a lot of borrowers and prospective buyers are seeing rates in the fives. And so I think as soon as you slap a five in front of that rate quote, it changes the game and
Yeah.
it generates this buzz. And there's something about five, I don't know what it is, that really gets people's wheels turning on home buying. Thankfully, right now those numbers are out there today, so we'll have a chance to see some response in the data between the time we're recording and the time this goes live. So hopefully we're right.
You mean we're seeing some five quotes today, some five handles for people today?
Oh, absolutely. Yeah. So, yeah, one good thing to understand about the MND rate index and rate quotes in general is you're dealing with an average, and you're also dealing with an average that lines up with something that is widely attainable. And there are lenders out there that make it a habit of operating on razor thin margins and competing very hard for business, especially lenders that are maintaining strong realtor relationships, and especially lenders that are affiliated with builders who have taken advantage of certain things that builders can do to offer even lower rates. So with those programs, you're definitely seeing rate quotes in the high fives today, no question, and
Yeah,
probably fairly widespread on the purchase side.
on the purchase side. And the builders are doing things like buying down rates and have been
Right.
doing that to really support prices and demand on the new construction side
Yeah.
for a while. When we look at the Mortgage News Daily, the daily rate index or average that you publicize that gets so much attention, how does it take into account, or does it, some of these like buy downs and incentives, like things on the how does that all get baked in? There's so many variables actually that go into mortgage rates.
Right.
How does that all come together in a thing like like today mortgage rates at 6.29? Like, how should I think about those?
Yeah, it's a great question, and I got to be a little bit careful about giving away proprietary stuff. But the really nice thing about it is there's no such thing as a 6.29% mortgage rate, and so this is our first clue as to what's going on. Mortgage rates, while some people dabble in like a 0.99 or a 0.49, you're generally going to see 99% of mortgage rate quotes go out on an eighth of a percent increment. So, 0.00, 0.125, 0.25, 0.375, etc. And the other nice thing about mortgage rates is that these are objective, hard numbers. And there are always only two components to the cost of a mortgage, and that's an upfront cost and the interest rate. And we're not talking about upfront cost to borrowers per se. We're talking about the upfront cost to an investor, so a bond buyer, right? We talked earlier about the prices of treasuries going down, meaning rates go up. So there's a price for all these bonds, and there is a price for all of these mortgages, whether it is a wholesale lender or a third party originator. There is a level of compensation, if you will, associated with any given mortgage rate. Where, let's say you're a wholesale lender and I'm a mortgage broker, and I want to offer a loan to my client at I don't know what rate yet. You're going to give me a rate sheet or a list of rate quotes via an online portal that shows me what you would be willing to pay me for giving you a loan at a certain rate. So let's say the going rate, or let's say the bond market suggests that a rate of 6.125% would be an even deal for both of us, where you wouldn't pay me any more than the principal of the loan. You'll give me that principal loan balance, and in return, you will get 6.125%. Now let's say, hey, my client's happy with 6.25. Everyone else is quoting 6.25, so I can do 6.25. You say, well, 6.25, I get 1/8% more interest. So instead of giving you, and by the way, let's say this house is 300 grand. Now you say, well, instead of loaning you 300 grand, I'll loan you $302,000. I'll pay an extra 2 grand in exchange for the right to receive that interest over time. That's, in a nutshell, the way that mortgage pricing works. There's always a grid, a tier, a breakdown of different levels of compensation associated with different rates. And there can be efficiencies and inefficiencies in that grid that have to do with, a couple of different things. First, we talked about prepayment fears. Lenders might not want to incentivize their mortgage originators to offer them higher rates because they don't want to have these loans that are at a high risk of paying off. So they might make more advantageous pricing down at those lower rates. Also, you have the underlying structure of the MBS market, which is a little bit esoteric, but let's think about it this way. MBS coupons, or, these securities exist in different flavors, different coupons, and they're broken up in 0.5 point increments. So that means that you have an MBS coupon that just pays 5.0%. You have one that pays 5.5, 6.0 in 0.5 point increments. And each of those coupons you can think of like a bucket. And the rules that are set by Fannie and Freddie say that only a certain range of rates can go into any given bucket. It happens to be plus 0.25 to plus 1.125. And that means that if you have a 5.0 MBS coupon, the highest rate that can go into that is that plus 1.125. So that's 6 1/8, 6.125. And the next higher coupon at 5.5 will only go down, to 5.75. And while it can also do 6.125, the 5.0 coupon cannot do any higher than 6.125. So if a lender, or if an investor is trying to get into that 5.0 bucket, right, they're trying to buy a group of loans that is less likely to be susceptible to these prepayment risks. And in so doing, you will sometimes see even better pricing for an interest rate of 6.125 than you will of 6.25, because that higher rate can't get into that 5.0 bucket. Does that make sense?
Mm-hmm.
And
Yeah,
with that, yeah. So with that being the case, it makes it a challenge to put together a daily interest rate index, because 6.125 is also 6.25. Sometimes the pricing is exactly the same. So our proprietary methodology takes that into consideration, and we use our experience and our network of loan officers, but also my previous experience as a loan officer, and thinking, how would I quote this if I were a loan officer? And what's the best deal for a client? Where are the efficiencies? Where's good break even here? And we come up with best execution in market terms. What makes the most sense? What's the most efficient? And rather than mess around with something like points, which, it's an accurate way to catalog what's happening with rates, to look at the interest rate and the amount of points associated with that. And points is just another way to represent that cost side of the equation that I mentioned. I don't like that, and here's why. It's not because it's inaccurate, it's very accurate, but I don't like it because people are just going to look at the rate number. They're just going to see that headline and say, oh, rates are down to such and such. It usually doesn't matter too much because points generally don't move too much, but there have been times where points have played an outsized role in getting rates to a certain level, and then people are looking at the index and wondering why, their rate isn't moving the same way that these indices say they should. So one of my first priorities when I took over the rate index from Adam Quinones, who created it, is to create a synthetic impact for points that could be translated into the interest rate. That way the points are always accounted for in the rate itself. And it's a little bit tricky at times, and it can create some more slippery movement when you get near those cutoff points of those MBS coupon buckets. It can make rates drop really quickly when they're getting close to 6.125, more quickly than normal. But if you look at what's happening in the land of mortgage rate quotes, that's also happening. You're seeing a very fast movement down from 6.625 to 6.125 because those are the two MBS coupon bucket cutoffs. But short answer, it started out as a very long one. The short answer is that the rate itself, synthetically and mathematically and objectively, accounts for the impact of points without having to treat them separately.
As a home buyer or a buyer in this market, do you have guidance about, do you have like when people say, oh, Matt, I'm thinking about buying a home. What should I think about rates? Or do you like, should I watch the Mortgage News Daily every day? What do you tell people, buyers, home buyers, when they're thinking about stuff?
Yeah, I love this question and this answer because it's so easy, and it's always been the same for me. Is you need somewhere to live, right? Uh, you need a roof over your head. You know when you are considering this house, you're going to move out of your old one and live in this one. In other words, is this your primary residence? And I'll assume, for the purpose of this question, that the answer is yes. I'm looking to buy a house I'm going to live in, and it's that simple. If you like it, you should buy it, and you shouldn't worry about what rates are if you can afford it. So, does the payment pencil for your financial situation? Is it somewhere you want to live? Other than that, you're really just dealing with local idiosyncrasies that affect supply and demand. Sometimes it is definitely a seller's market, and you just have to cope with those realities according to your ability to do so. Are you able to offer more than the purchase price because it's super important to you to get that house over other people? Well, that's your choice. Right now, I don't think it's necessarily as much of a seller's market. Some people would say it's a buyer's market in many geographies. And, you should offer the purchase price and not agonize over rates day to day. You shouldn't agonize over your lock decision, especially if rates have just fallen quite a bit and they're lower than you thought they were going to be. Lock that loan, get your purchase contract underway, and move forward. Because if rates are really experiencing this wave of downward momentum that you're worried about missing out on by locking your rate, well, guess what? You're going to be able to refi that loan within a year at a rate that makes sense anyway. So it's more important to lock up your primary residence housing payment and move down the road. Now, if you're talking about non-owner occupied stuff, second homes, things that you don't necessarily need, or you're not moving out of the area and you need to make sure you get this house to have a place to live for your new place of employment geographically, then it could be a little bit of a different story.
Yeah.
For the average home buyer, you don't need to agonize over what's going on with rates day to day.
Yeah. That is in fact exactly what I tell people when they ask me the same question. Should I wait? Should I buy this one? Home prices, are they going to go down? And it's, if you like the house and you can afford the house, buy the house. If you don't
Yeah.
like it,
And I
or
want to emphasize, you and I right now are not just a real estate guy and a mortgage guy trying to talk our book or trying to pump up the market that we work in. Nothing could be
yeah,
farther from the truth, because I'm happy to like pour cold water on a lot of that kind of stuff. But in this case,
yeah.
it really is true.
Well, and yeah, for sure. And it's like the opposite side is true too. If you don't like it or can't afford it, don't buy it. Don't buy it because you think you have to, or you think it like, I got to get
Right.
in now. Like, if you can't afford it, don't do it. If you don't like it, don't do it. So I think
And
that's the only guide.
if you're seeing other comparable inventory that suggests you have other options, don't get in a bidding war over a house that's not too different than seven other houses you could go look at.
Yeah. That is an excellent, excellent place to leave our conversation today. We've already blown through an hour, Matt. We had so much to talk about. I appreciate your insight on the mortgage markets and rates. And even though you didn't want to give me a prediction for 2026, I appreciate the framework is really what matters. What we're looking at is like what's happening to the universe, and therefore how we can act according to where rates ultimately move. So, Matt Graham, thank you so much for being our guest today and Compass Real Estate Conversations and MBS Live, Mortgage News Daily. Where do you send people to follow and your work and track?
If you're a consumer, mortgagenewsdaily.com, and if you're in the biz, mbslive.net.
All right. And we sometimes chat on Twitter and other places too. So we
For
got
sure.
stuff going on.
Yeah, thanks for having me, Mike. It's always a pleasure.
Matt Graham, thanks so much. All right, everybody. That is Compass Conversations in Real Estate, and we'll be back very soon with another episode. Real Estate Conversations podcast is brought to you by Compass Academy, the go-to source for real estate agent education and on-demand learning. All Compass agents have access to Compass Academy's extensive library of content, video, and technology for building a high-performance real estate business. Compass Academy is also one of the reasons that Compass agents are the most productive in the industry. Learn more at the Compass Academy link in the episode's show notes.